deep into some listener submitted stuff today.
Absolutely.
So we had a listener write in. Seems like they're really trying to get started with investing.
Oh, very cool.
Yeah. And send us this really cool guide all about mutual funds.
Okay. Yeah.
And so we are going to be talking all things mutual funds today. How to get started.
Yeah.
Different kinds of funds, how to pick them, the whole 9 yards.
Yeah. I mean, it's one of those things I feel like everybody hears about mutual funds, but not a lot of people actually understand.
Yeah.
Like how they work or the advantages to investing in them.
Exactly. And so that's what we're going to be breaking down today. So before we even jump into the different kinds of funds, this guide really stresses the importance of like setting a goal.
Yeah.
Like, what are you even doing this for?
You got to have like a blueprint. Like if you were going to build a house,
Yeah.
you wouldn't just start laying bricks.
Exactly.
You'd have an idea of like, okay, how many bedrooms do we want? Yeah.
How many bathrooms, what kind of kitchen, like that sort of thing.
Totally. So are you saving up for a down payment on a house?
Yeah.
Are you, trying to retire early?
Right.
Is it 10 years down the line? Is it 20 years down the line?
Right. Because those are going to determine, what kind of approach you take with your investment.
Totally.
How much risk you're willing to tolerate.
Yeah.
So
yeah,
it's all connected.
It is. So that kind of leads into what you're saying about like risk tolerance.
Yeah.
So like, obviously if you're, 20 years out from retirement, you might be willing to take on a little bit more risk.
You can weather those ups and downs a lot more.
Exactly.
Yeah.
Yeah.
So like if, the market takes a dip.
Yeah.
You're not, freaking out and selling everything.
Right. You have time to recover.
Exactly.
Yeah.
It's like, think of it like a roller coaster.
Yeah.
Some people want the really intense, crazy
high speed drops, and some people prefer, like a nice leisurely ride.
Yeah.
So figuring out what kind of roller coaster you're comfortable on is really important.
Okay. I like that analogy. So that makes total sense.
Yeah.
But before we even think about investing in a mutual fund,
yeah,
this guide really pushes that you've got to have your emergency fund in place first.
Yes.
So important.
Yeah. You don't want to be in a situation where, let's say, like an unexpected medical expense comes up.
Right.
Or, God forbid you lose your job. Mm-hmm. And suddenly you need to access your money, but all of your money is tied up in investments. Mm-hmm. Mm-hmm. So having that 3 to 6 months of living expenses in a separate, readily accessible account is super important, so you're not forced to liquidate.
Yeah. Sell your stocks or whatever.
Sell at a loss. Exactly.
Yeah. When you really need the money.
Yeah.
So, okay. So, emergency fund. Check. We've got our goal in mind.
Yeah.
Now we're finally ready to talk about the funds themselves. So this guide broke it down into 4 main categories of mutual funds.
Yeah.
So the first one we're going to be talking about is equity funds.
Oh, okay.
Which I feel like those are the ones that everybody hears about.
Right. It's the sexy one, right?
It is.
High growth potential. Everybody wants to, get in on that.
Yeah. So tell us a little bit more about what exactly is an equity fund?
Sure. So an equity fund basically is a pool of money from lots of different investors that is then invested in primarily stocks.
Okay.
So think of it as you're owning tiny pieces of lots of different companies.
Okay.
And of course, the value of those companies can go up or down. But over the long term, historically, stocks have tended to go up.
Yeah.
So that's why equity funds have that higher growth potential.
Okay. So equity funds are definitely, associated with a little more volatility.
Sure.
So is that why, a lot of times it's people who are, younger who are invest in those equity funds?
Yeah. They have a longer time horizon. They can ride out those ups and downs in the market a little bit easier because they don't need the money right away.
Exactly.
Whereas someone who's, nearing retirement, they may not have that same luxury.
Totally. Okay. So that's equity funds.
Yep.
Next one is kind of the opposite of equity funds is debt funds.
Right.
So tell us a little bit more about those.
Sure. So debt funds, instead of investing in stocks, they invest in bonds, which are basically loans that are made to governments or companies. And when you invest in a bond, you're essentially lending money to that entity, and they're paying you interest.
Okay.
So debt funds tend to be a little bit more stable than equity funds because, bond prices don't fluctuate as wildly as stocks.
Okay.
So they're often used by investors who are, looking for a more conservative approach. Maybe they're looking for income. Okay.
They're not They're not looking to like get rich quick. Yeah. They're looking for that slow and steady kind of return.
Okay. So equity funds, more risky, higher reward potential. Debt funds, more stable, a little bit lower reward.
Correct.
Okay, cool. Next up is kind of a mix of the two.
Right.
It's called balanced or hybrid funds. Mm-hmm. So basically, it's exactly what it sounds like.
Exactly. A little bit of column A, a little bit of column B. Yeah. So it will typically have a mix of stocks and bonds. Mm-hmm. And the exact proportion will vary depending on the fund.
Right.
But the idea is that, you're getting that diversification. Mm-hmm. You're getting some growth potential from the stocks.
Yeah.
But you're also getting some stability from the bonds.
Yeah.
So it's a good option for people who, want to dip their toes in both.
Yeah.
But maybe don't want to go all in on one or the other.
Right. So maybe they are, a little bit older.
They can't tolerate quite as much risk as somebody in their 20s or 30s.
Exactly.
But they still want some growth.
Yeah.
Okay, cool. And then last one, this is one that I feel like I've been hearing more and more about. Mm-hmm. Index funds.
Yes.
So tell us a little bit more about those.
Sure. So an index fund is a type of mutual fund that basically just tracks a specific market index, like the S&P 500, for example, which is, a basket of 500 large U.S. companies. Mm-hmm. So instead of having a fund manager actively picking stocks and trying to beat the market, an index fund just basically mirrors whatever that index is doing.
Okay.
And the advantage of that is that it's very low cost.
Right.
Because you don't have that overhead.
Right. You're not paying
of an active manager.
Right.
Exactly. And also they tend to be very tax efficient.
Okay.
So they've become really popular in recent years, especially among people who are, just starting out or who are looking for a more hands-off approach.
Right.
It's kind of like a set it and forget it type of thing.
Totally. So we've got all our different kinds of funds laid out. Mm-hmm. We know, generally, which one might be a good fit depending on our goal and our risk tolerance. Mm-hmm. But how do we actually how do you pick a specific fund?
For winning horse.
Right.
Yeah, exactly.
So there's a few things you can look at.
Right.
One is performance history.
Okay.
Obviously, past performance doesn't guarantee future results.
Right.
But it can give you an idea of how the fund has performed in different market conditions. Mm-hmm. So you don't want to just look at the last year or two.
Right.
You want to look at a longer track record, like 5 years, 10 years, ideally even longer.
So we're not just chasing the latest fad.
Exactly.
Yeah. Okay.
Another thing to look at is the expense ratio.
Okay.
Which is basically the annual fee
that you paid to the fund manager.
All right.
And obviously you want to keep that as low as possible because, every dollar that you're paying in fees is a dollar that's not working for you.
Exactly.
And then if you're looking at actively managed funds, so funds that have a fund manager who's picking the stocks, you want to look at their track record.
Okay.
See, how have they performed in the past? Mm-hmm. Have they consistently beaten the market? What's their investment philosophy?
Right.
That sort of thing.
So it's not just looking at the horse, we're also looking at the jockey.
Exactly. You want to make sure you have a good jockey on your horse.
Exactly.
Okay.
Okay, cool. So we've done our research. We've picked the perfect fund. Mm-hmm. We're ready to invest.
Right.
Now, the guide talk about two different investment strategies.
Okay.
One is like the lump sum investment, and the other is SIP.
Right.
So tell us a little bit more about those two.
Sure. So lump sum investing is basically you have a chunk of money.
Yeah.
You invest it all at once.
Okay.
And that can be a good strategy if, you think the market is going to go up and you want to get in right away. Mm-hmm. But it can also be risky if the market happens to take a dip right after you invest.
Right. So SIP would be more of the dollar cost averaging.
Exactly. So SIP stands for Systematic Investment Plan.
Okay.
And it's basically you invest a fixed amount at regular intervals. So maybe you invest $100 a month or $500 a quarter.
Okay.
And that way you're kind of averaging out your purchase price over time.
Right.
So you're not as affected by those short-term fluctuations in the market.
Yeah. And you're not trying to time the market.
Exactly.
Right. You're investing consistently.
Exactly. And it's also a good way to just kind of build that habit of investing.
Totally. Okay. So let's say, we've got our fund picked out. Mm-hmm. We've got our strategy.
Yeah.
How do we actually open an account?
Sure. So there's a few different ways you can do it. You can go through a brokerage firm.
Okay.
like, Fidelity, Vanguard, Schwab. A lot of those firms have, really user-friendly websites and apps that make it pretty easy to open an account and start investing. You can also invest directly through a mutual fund company. So, like, if you want to invest in a Vanguard fund, you can go directly to Vanguard's website and open an account.
Okay.
And then some banks also offer mutual funds. So you might be able to open an account through your bank.
Right. Okay. So there's lots of options.
Yeah, don't feel limited.
Yeah.
Shop around,
Right.
See what works best for you.
See what platform feels right.
And also, don't be afraid to ask questions.
Yes.
If you're not sure about something, ask the brokerage firm, ask the mutual fund company.
Yeah.
There are people there to help you.
Yeah. They want your business.
Exactly.
Okay, cool. So last thing, this guide really emphasized, like, once you're invested, you've got to, like, stay the course.
Yes.
Don't panic.
Investing is a long game.
Yes.
It's not about getting rich quick. It's about, steady growth over time. And there are going to be ups and downs in the market.
Oh, yeah.
There's going to be times when you're like, oh my gosh, I'm losing money. But, unless you absolutely need that money right away.
Right.
The best thing you can do is just write it out.
Yeah. Stay the course.
Exactly.
Don't panic and sell everything when the market dips.
Right. Because historically, over the long term, the market has always gone up.
Right. It's just those dips that are scary.
Yeah, but if you sell when it dips, then you're locking in those losses.
Exactly.
So, stay informed, pay attention to what's going on in the market, but don't let it, dictate your every move.
Yeah.
Don't get caught up in that day-to-day noise.
Right, exactly.
Yeah.
So to kind of sum up everything that we've talked about, mutual funds can be a really great way to get started with investing, especially if you don't have a lot of money to start with.
Right.
There's lots of different kinds of funds to choose from, so you can find one that meets your needs and your risk tolerance. Do your research, pick a good fund, set up an account, invest consistently, and stay the course.
And be patient.
Yes, and be patient. Awesome. Well, this has been super informative.
Yeah, this was fun.
Again, this is all based off this one guide that a listener sent us.
Yeah.
Which was super awesome of them to do.
Yeah, thanks for sharing that.
But I would encourage everyone, to do their own research.
Absolutely.
There's tons of resources available online. And, talk to a financial advisor.
Yeah.
Talk to someone you trust.
Exactly. All right. Well, this has been super fun.
Yeah.
We'll see everybody next week for another deep dive.
See ya! Woo!